Hi, everybody. This is Gary Dean, and this is our weekend video report for Monday, January 2nd, 2017. I hope you guys had a fantastic new year. And from here, man, I think 2017 is going to be a pretty exciting year overall for the markets. One thing that I've been saying after talking to Woody is he's expecting at least two 20% corrections to happen in 2017, but it's going to be within an overall, say, uh, bullish view, meaning that these 20% corrections are going to be followed probably by 21 or 25% recoveries off of it. So the good news about that is there's going to be some huge price swings that are going to be taking place. And what we really want to do is be patient and simply position ourselves when we see the markets either about to break down or find support. And right now, the chart I'm showing, this is the daily chart of the S&P, and we've still always been trading with this bearish rising wedge pattern. And we broke through it, but all this was just an ABC move, and it found support at the moving average. And from there, we then came up and tested the top part of the wedge again. So this alone, this pattern is looking for a decline down to the 1988, 1908 level. When that happens, we're gonna, I'm not mentioning this to get into a trade right now on the short side. It may head down there, but I still think we're gonna chop around a little bit before we come down and reach these targets, and that may be sometime in 2000, for quarter one of 2017 is what we're going to be watching. So this is what I'm looking at as far as with the daily, the 60 minutes, and then the 15-minute chart. So the daily chart, we don't have any bearish divergences. So what that is assuming is that the S&P is going to find support. Maybe it goes deeper and it comes down to this 2200 level. That's price support here, and we also have a moving average here. Now, if it doesn't hold at this 2200, then we would be eyeing down to 2169 or the 200-day moving average, which is 2136. So these would be the support areas to be looking to buy for a move up that is then going to give us the bearish divergences on the daily chart, and that it will probably set up the larger swing trade to the downside. You can see that we're very, very excuse me, overbought on our momentum here. So it's been, the problem with trading let's say momentum, and that's what we've been trading off of since Trump has been elected, is it's just been momentum. But the technicals have been warning for some type of pullback, and in the last couple days of 2016 for trading, we did see the S&P find some selling pressure. Now, in the past couple years, the first few trading days of that year in January has been pretty bearish, and we've actually had a pretty bearish January overall. It doesn't mean that it's going to be the same. And really the biggest difference from the past couple of years to now is we had bearish divergences as we are going into the first of the year. This we don't. So it may be where it comes down, lure some shorts in, and then they squeeze them back up again. So that the daily is looking for a higher high than this 2281. Now, if you look at this 60-minute chart, we don't have any bullish divergences here. So what that is saying that is we should anticipate some kind of bounce that's going to fail, and then it's going to take out these lows, and that is going to form the bullish divergences. So the daily is looking for support to hold. 60-minute is looking for as some type of bounce. Well, actually, the 15-minute is looking for some type of bounce, but the 60-minute chart is saying that this bounce should fail, and we're probably going to come back down. Now, on Thursday, I had said that we saw some bullish divergences on the 15-minute chart, so that would kind of leave the door open for some type of bounce. And I was really looking for it to get up to this the 2261 level. And really what happened was we just had to push higher, and then from there we saw sellers step in. So the 15-minute was looking for the bounce. The bounce didn't go as high as I was anticipating, but it made sense as far as the move, because here you can see we have this A, and then it's really just like kind of a subdivision of ABCs, meaning ABC of an A, and then we just went ABC, let's just say B, and now we're making the C. It doesn't really make a difference how we do it, but my point is that it's, there's not really an impulse move. So this is suggesting that we probably are going to see some type of bounce in the coming days, and it's then looking at the 60-minute, that meaning that bounce is probably going to fail. So if we come in tomorrow and let's say they find some buyers, and they continue up, really the first level that the bulls have to push through is going to be this 2247 level. If they get above that, then we're looking at this 2258. Now, if you're looking for a short trade, this would be the area that I would wait for, and then all we're doing is just put your stop above here. So the risk reward would be there, because if you can get short somewhere at this 2258 and the target's going to be someplace down into the 2214, that's a good trade, and you're really only risking 14 points, or say like a little about a 0.5%. Let's just say that. So it could definitely work for that. You can see here that momentum is getting pretty oversold right now. So it's, with the bullish divergences on the 15-minute and the oversold levels on the 60, I would say that I'd be a little cautious jumping with new positions on the short side. Now here you can see that we landed on the moving average right here. So this found some buyers, and we had the 23% retracement that's at the 2231 level. So this is your support level, and if they do open up higher tomorrow, then you just want to be patient and wait to see how it reacts up in this area here to possibly take a short position, and then with the expectations that it's going to come someplace down into the 2200 level, and that will form the bullish divergences. So again, the 15-minute chart is looking for a bounce because of the bullish divergences, but the 60-minute is saying that this bounce is going to fail at some point, and then we're going to come back down and form the bullish divergences. And the daily chart is saying that whenever we have this, if it plays out as scripted, and this we do make lower lows, that this dip here could be bought because we are anticipating higher highs on the daily chart. So that's really kind of the roadmap that I have right here, and it's I really think that the easiest way to do it, if the bears can push through this support level right here with the moving average, let's say the 2234, then most likely there's going to be a reaction trade down to the 2212. So you can take a quick trade on that. If this doesn't hold, then we're going down to the 2203. This is probably where I'd be looking, to possibly buy in, anywhere from this the 2213 down to the 2187. This is where I'd be interested in layering in a long position in this support zone here. And what the bears need to do is really keep the S&P say below this 2258 level. Anywhere up here, I'd be interested in shorting. Anywhere down here, if we start to see bullish divergences forming, I'd be interested in buying. So let's see what plays out tomorrow. Enjoy the off day today, and we'll be up and at 'em early tomorrow. And like I said, I'm pretty excited about 2017. And with that, have a great day, and I'll talk to you guys tomorrow.